We do think it makes a lot of sense to add to a multi-asset portfolio. We do think bonds from a starting point, from a valuation starting point, are likely to do very, very well versus equities over the next 5 to 10 year period. It's important, all of us as investors, that the Fed maintains significant independence regarding monetary policy decisions. We think that will likely be the case. We think a lot of the candidates being discussed will be sufficiently independent to make decisions that will keep the market generally comfortable. We've had dovish Feds in the past. The current Fed more recently has acted more dovishly, but we don't think that's a major concern. Given how high equity valuations are and given how tight credit spreads are, combined with some more aggressive underwriting in recent years, we do think that the risks are slightly higher that there could be some type of major shift in confidence that impacts equity or credit markets that could lead to a little bit of economic weakness. Again, very far from our base case, but we do think that, given pretty elevated starting valuations, that risk is likely a bit higher. Then the third piece I already addressed, and that relates to global fixed income as being a part of a multi-asset portfolio. We think that this is a contrarian but still very attractive way to generate or maintain high returns while providing significant downside protection. People are probably looking at me and saying, oh God, this is Dan Ivison, the CIO of a bond firm, telling us to buy more bonds. And I guess that part's true. But just a few years ago in our very flexible mandates, we owned very little fixed income, longer maturity exposure. So, end of 2021, we had the lowest interest rate exposure across some of our more flexible strategies that we've had, I think, in at least a 30-year period here at PIMCO. And today, we are putting our money where our mouth is, so to speak. And on behalf of clients in these multi-asset strategies and flexible strategies, diversifying into an area that still has some folks that don't fully buy into the value proposition. And I think that's a great opportunity. The yield curve question is an important one, though. Also traveling over the last few weeks, a lot of investors have said, well, wait a minute, the market, the bond markets rallied last year. Yields are lower. Does that mean the opportunity in fixed income's gone away? And I think it's important to note that cash rates across many parts of the world have come down. Shorter maturity bond yields have come down. But long maturity treasuries, long maturities in Japan, the United Kingdom, Europe, other parts of the world significantly underperformed and actually went up quite a bit last year. So 2004, 2005 were very well all about keeping your maturity short to generate some alpha. We're not quite there yet, but we suspect that 26 and beyond may be very much about beginning to add some of that exposure in some of the longer maturities that have repriced so significantly. That doesn't mean take more interest rate risk. It just means take a different type of interest rate risk. And that's an example of an advantage that you have in the flexible public fixed income markets versus the private markets. The private markets that are very illiquid allow for one opportunity. That is the decision to buy the asset. In the multi-sector or in the public markets, public multi-sector or fixed income, you can change your mind all the time. And I do think on a go-forward basis, you'll get paid a lot to be able to change your mind and to shift into more attractive areas of the market. So again, pretty high conviction relative to where we were a few years ago in terms of return generation.
Yeah, I think that what we have the ability to do and what we're trying to do on the private side is a lot of the similar themes of investing that Dan talked about on the public side, which is looking for sort of resilient downside protection. That's the core is protecting our clients' capital. But unlike Dan, who has a lot of total return potential through trading, which you just mentioned, we don't really have that on the private side. You know, we're more of a buy and hold. We're not going to have that opportunity to sell. So for upside, a lot of times what we're looking to do is build in some equity-like upside through warrants or through some sort of unique ownership where we can get to that sort of low mid-teens returns. And a very good example of a deal that we just did sort of in that AI infrastructure universe is a pipeline deal based in Texas where we're funding the build out of the pipeline from the Permian Basin where the natural gas comes out of the ground all the way down to an export facility on the coast. And the downstream buyer has fully guaranteed the volumes over the next 20 years. So very similar to a lease from a hyperscaler. So you're guaranteeing that cash flow for 20 years with an investment grade company. So we really like that high quality cash flow stream, a lot of downside protection. But we're also structuring an upside in that as long as we deliver that volume to the buyer, the project works. It's about a 9 to 10% return. But we can build laterals off of that pipeline to fire up all of the natural gas-fired AI plants along the way, which are all going into Texas and all need natural gas because that's just the quickest way to generate power. And if you want to build a data center right now, most of them are natural gas-fired. So we can build laterals off the pipeline and that's all excess return. And so we're underwriting that deal to about a 30 to 35% IRR that has phenomenal downside protection. So you kind of get a little bit of both. And listen, that's sort of a Goldilocks scenario. Not every deal is like that. But that's what we're trying to solve for in a lot of the private side investing.
So just in terms of the dollar, let me start with a few, I think, important points. One, we don't think that there's any risk over the short term of the dollar losing its global reserve currency status. People are still attracted to the United States because the United States has a strong economy. It has a very dynamic and leading technology sector, like Taiwan, like China. Returns have been very, very good. We have very large capital markets for both good and bad reasons. The good reasons is we have a large productive economy. The not so good reason is that we're issuing a lot of debt. But the point is that we don't think that there are meaningful risks in that regard. But also, the U.S. has performed very well in absolute and relative terms, U.S. markets, that is, in the economy. Valuations across U.S. assets versus global assets are quite high. And investors, if they listen to what we've been saying here on stage, can certainly benefit from owning a few other things, not because the U.S. is bad and those other things are good. It's just that, from the standpoint of diversification and, a slight valuation advantage, it makes sense. So over many, many years, we've seen institutional investors and central banks gradually diversify out of U.S. assets into other things, including metals. Would expect that to continue over time in a fairly orderly fashion, most likely. And yes, given that the dollar screens expensive versus other currencies, you could see some dollar weakness over time. So our general view is that over the next few years, you see a little bit more dollar weakness. We're not overly alarmed, nor do we think investors should be overly alarmed by that. But it doesn't have to move in a one-way direction. We wouldn't be surprised at all if the dollar were to recover and end of the year up. If it were to end up, it would probably be based on the fact that the Fed ended up staying on hold, that growth reaccelerated, which we do think is likely, and that the U.S. tech sector continued to perform exceptionally well. None of those are unreasonable, and those very well could coincide with some surprising dollar strength. So, bottom line is that we do think that the dollar probably weakens, not for deeply concerning reasons, but you're going to have a lot more currency volatility. Consistent with what I mentioned earlier, when you have geopolitical uncertainty, geopolitical tension, when you have tariff policy changing overnight, like it can change, that's going to lead to a lot of volatility, which creates both opportunity and risks for those overly concentrated. Emerging markets, consistent with the diversification theme, both emerging market equities and debt, emerging market currencies, local rate markets, all look reasonably attractive. So again, consistent with what I mentioned earlier, if you've been in a lot of U.S. equities, if you haven't owned a lot of emerging market debt, you as investors like PIMCO should consider increasing your allocations to these areas of the market. Local emerging market bonds did exceptionally well, providing significant double-digit returns last year. We think it's a great diversifier within a portfolio and across nearly all flexible PIMCO strategies. We have small but still meaningful positions to a diversified pool of emerging market risk. So again, pretty high conviction over the next few years that that will be a sector that people don't talk about nearly enough. Will end up generating very attractive returns relative to certain U.S.-focused credit investments, as an example.
Okay, so let me just quickly summarize for at least my takeaway for today's discussions and Dan and Ross's presentation. I think first of all it is the attractiveness for high quality fixed income, right? Especially in the context of people owning a lot of equities in the multi-asset context. Second, we talk a lot, both Dan and Ross talked about the importance of diversification, right? There are a lot of opportunities globally, and we are harvesting that in the multi-context portfolio. And finally, I think active management, especially in credit, right? I think both gentlemen have spent a lot of time and emphasis, and Dan mentioned there's only one takeaway for today's sessions about being very selective on credit, right? Especially on the lower quality. So definitely something wanted to leave the audience with.